Morning, everyone. Firstly, thank you for joining our webinar. Today, we will be talking about detecting and preventing bank frauds and how to leverage best practices, technology, and artificial intelligence to protect your institution. My name is Arturo Flores. I am the financial crime consultant here at Caseware, and joining me is Josef Fiestal, who is our data scientist. Include some bank fraud types that have the higher impact in the industry. We will review some challenges faced by the banks, along with some fraud losses in terms of monetary value. We have a few case studies that we have prepared for you, and we'll take a look at some preventative measures at the banking level, and lastly, a Q&A. So there are many types of fraud in the banking world, and we've identified some, such as card not present fraud. So CNP fraud, which includes internet fraud or mail and telephone fraud. So this results when victim information is obtained by phishing techniques, hack computer, or as simple as a stolen mail. Phishing operates usually by sending a fake email to the victims, impersonating an online bank, a retail, or a payment site, and it asks the users that they must update their personal information, such as the name, address, date of birth, phone numbers. Sometimes it will ask for your card number and expiry date and the 3 numbers on the back of the card. So once the information is stolen, it's then used for other frauds such as ID fraud or online fraud. There's also counterfeit fraud. There's lost and stolen fraud. Again, there's identity fraud, which results to fraud applications. Products such as credit cards or loans are obtained using fictitious information, stolen ID, or information of deceased individuals. So once a fraudster is successful at obtaining and utilizing the maximum limit of the product, the liability and remediation falls on the victim. Again, the victim will be held liable for the balance until the investigation has been completed. There is account takeover fraud, internal fraud, and there's also check kiting or bust out fraud. Bust out is a method of knowingly depositing useless checks with the intent to utilize the available funds prior to the fund clearing. So let's take a look at some challenges faced in the banking industry. One challenge right now is minimizing fraud application. So fraud apps is a big concern in the industry because of the monetary value tied to the account losses. There is also little to no recovery when in terms of fraud application, and it's increasing due to a high success rate of phishing techniques online, and banks have challenges with identifying the root cause of these ID fraud. So this picture here just shows that from 2017 to 2018, there's been an 8% increase in ID fraud, which translates to 16.7 million consumers in the US, and is equivalent to a $16.8 billion in terms of ID fraud loss. Again, it's becoming a challenge because there's a lot of breaches that's happening out there, whether it's retail stores or breaches online sites, and banks don't have control with those breaches. Some other challenges that are faced by the banks are keeping up with fraud trends. As we know, fraud evolves all the time, and banks and solutions need to adapt to these fraud trends ASAP to minimize their losses. Capacity is a challenge. Basically, it means, does your bank have the capacity or the people, manpower to work alerts in terms of volume? The customer disruption rate. As a bank, you want your customer to use your product and to minimize the disruption. So how much risk are you taking to balance out your revenue and loss? Screening, again, your role is to ensure that you're not doing business with known criminals or terrorist entities, which results to reputation risk. And again, minimizing fraud application. Some banks out there don't have the proper solution with, example ID verification during the onboarding process. This results to fraud apps, or again, reputational damage, which ties to loss of customers. So we'll take a look at some fraud loss. We have identified 3 fraud types. We have card not present, counterfeit, and the lost and stolen fraud. Let's look at the CNP fraud. So from 2012 to 2018, there's a significant increase in CNP. It comes up to a 3.8 billion increase. Again, CNP continues to grow, which includes the internet fraud, mail fraud, and telephone fraud. Some memorable mentions, I think, it was also a significant fraud trend in terms of CNP was the government agency scams. You have the IRS and the CRA scam, and also there are the romance scams that's been happening. Lost and stolen fraud shows a similar or a smaller monetary value due to its risk of obtaining the actual card. Again, there's a lot more risk in physically trying to steal someone's card, so the losses there hasn't really been an increase throughout the years. And lastly, there's counterfeit fraud. Counterfeit has declined due to the EMV code, so the Europay, MasterCard, Visa and Company chip-enabled cards. More banks are upgrading to this technology, and more stores or merchants out there are accepting this method of payment. As you can see here, in 2015, there was a 3.6 billion in terms of loss, counterfeit loss, and then in 2016, 2017, 2018, it's a decrease, and that is because of the chip liability shift, which was implemented in late 2015. Again, the chip liability shift basically just says that if a merchant does not invest in a chip and pin technology, they will absorb the fraud loss. And we'll take a look at a case study, just an overview of the case study. An account generated alert was triggered based on your internal strategies. Ronaldo Tramo's credit card was maxed and flagged due to the following indicators. So just again, quick overview of this slide, of this image. This is a print screen of Alessa. All information that's been added on this screen are fictitious, and everything is customizable dependent on the client requests. So on this slide, the first unusual indicator was three $2,000 transactions at an electronics store. This part just shows the rule or the alert that was identified. On here is the total value of the transactions. This is the threshold that we put as an example. And this part of the screen shows the customer information. You have the name, address, vendor information, merchant information, date, time, and other relevant information tied to the transaction. It also has the notes and investigative steps that were taken. Again, Alessa has the capability of notating the account with your investigations for review or audit purposes. So back to the case, this is one of the unusual indicators. Second unusual indicator on the transactional level was a $3,000 purchase at a jewelry store. So Ronaldo went to Doriana Diamonds and bought $3129.99 for a diamond necklace, which was done the same day. There were also 4 $500 gift cards at AJ Mart, a check payment for $12,000, and a single transaction for $1.90. So this page just shows the $1.90 purchase, and it also linked the account to other unusual transactions that we've identified. So upon reviewing the account, you notice that Ron also attempted to open 7 other products in the last month with your bank. You found other applications with different information along with unusual indicators in the credit bureau, such as a newly established bureau in 2018, The applications show that Ron provided different addresses throughout the applications. Some were UPS boxes, some were commercial addresses. There was also different phone numbers given, different employers and income, and different ID given to open up the accounts or to apply for different types of products. There were permanent residency cards, SINs, driver's licenses. There were also no other trades in the credit bureau, and there were aggressive inquiries for 6 additional products from retail stores and other banks. So as the investigator, how would you action this account based on your finding? Would you leave the credit card open since Ron is just trying to establish himself? Or would you close the account due to high-risk indicators of fraud? I'll just give you a moment to answer that. And I thought I'd just give you my investigative approach. As the investigator, and from experience, there are multiple unusual indicators linking it to fraud application, such as newly opened account. There were aggressive transactions at merchants that sell items with high resale value. There were different information found on subsequent applications. Bureau information versus application information indicate high-risk activity due to different information given, such as phone numbers, employers, and IDs. So by doing that, the fraudster is trying to evade bank strategies. There was a large check payment, and as we saw in the investigative notes, it was a large payment over the monthly income given, followed by a small value transaction, which is a sign of testing the card for approval. So what I would do to the account is I would close the account immediately. I would search the internal database and scrub for existing accounts that were possibly affected. I would flag all information, all the KYC info, the name, address, date of birth, employee information, and by flagging, I'm trying to prevent additional application. And lastly, I'd try to locate a victim, if any. Again, information given on the application could be fictitious. Switching it up to a check kiting overview. Safe Bank. So Safe Bank is an acronym that was invented in the early 90s by banks and law enforcement agencies, basically to detect check kiting activities. So Safe Bank, again, is an acronym, so all the letters mean something. So S stands for signature and payee on kited checks are often the same. You have A, which is area abnormalities. So many out of area checks or out of region checks, sometimes international checks are being deposited. F is frequent deposits, check writing and balance inquiries. So multiple deposits and someone constantly checking balance for available funds. E is for escalating balances. B is for bank abnormalities. Deposit, this means deposited checks are drawn on the same bank. A is for average length of time. Basically, the average length of time money remains in an account is short. N is NSF problems. And the K stands for keep banks from recognizing frequency of transactions by using ATMs, night drops, drive-through, and other branches for deposits and withdrawals. Again, it's a way to evade detection and face-to-face encounters with the tellers. I will now pass it to Josep, who will provide us some insight on how to leverage artificial intelligence and data to help solve certain fraud types.
Okay, thank you, Arturo. I would like to take this time now to go into some use cases that we've had here at Alessa, specifically check kiting and stolen card examples. So let's get into it. The first example we have was a check kiting case study we came across. And before I actually give you the examples, in a past webinar, we explained sort of the techniques we use to create our models. And, you could either watch that or I'll give you a quick explanation of quickly what's going on. Basically, our models, we begin with what's called a ground truth. And this ground truth, in a very simplified explanation, is basically taking all of the user's data and sort of scrunching it down into a little ball. So that any outliers, when compared to the original data set, sort of stick out a lot more than they would normally. And this is done through machine learning and lots of repetition. The advantages of this obviously are that each data set and each ground truth is very specifically tuned to an individual client's customer base. So, obviously people in, let's say in Japan, have very different shopping and banking patterns than someone in, let's say, the Middle East. So being able to sort of create this ground truth based on and very biased towards a user's client base is very important to us. What the actual technique we use to create this ground truth is what's called an autoencoder. And the autoencoder very, very simply takes a transaction, so to speak, scrunches it down, creates and finds dimensions or patterns, and sort of tries to recreate this. So at the top half of the autoencoder, it's sort of trying to discover what it can about it and sort of what columns and what values link to each other. And then on the bottom half, when it tries to recreate it, it will obviously not be perfect. And this reconstruction error is actually what we use to determine the outlier. So if a transaction comes in that none of the patterns met the previous pattern, it is unable to actually reconstruct it. And that's where we get the error and be able to be discovered as an anomaly or an outlier. In this example, we actually have two layers two nodes in the middle of the autoencoder. And one of the reasons we do this is actually so we are able to visualize it. A lot of this is just pure numbers and, very difficult for the human brain to comprehend. So we choose you could choose any arbitrary number, 2, 4, 20, 50. Again, but with 2, you can actually map it to an XY axis, and we can actually get, very good graphs out of this. And this helps us determine what we should do next. And after this, this is obviously just a ground truth, and it's a very, very simple, anomaly detection model. But to actually start targeting very specific use cases, we actually use what's called transfer learning. So on top of this model, using everything it's already learned about the sort of the user data, we add a very specific model on after that, and that's basically just called transfer learning. It's sort of taking all your knowledge from grade 1 to 6, and then sort of giving it a high school education, so to speak. So this was an actual use case we had, and this was for check kiting. And this is a very quick overview of the client's data. And so in this chart, it's divided into two basically. There were regular transactions and then NSF transactions. And so the NSF transactions, as you can see, were very easily discernible. So people who had at some point in time their account has been NSF, or it still is NSF at the time of the transaction, were very easily identifiable by the model. So we looked at this, and if you can see here, there's a couple sort of overlaps, these little blue overlaps that sort of started to pop up here and there. And so this was the model being confused, and this is someone who has never been NSF, but is acting as if they had been. So we decided to sort of take these numbers and sort of expand on it and look into it into a lot greater detail. And, we found a couple overlapping user IDs. And so this was sort of just the anomaly score that we got on each of these. Explaining this very quickly, the blue line here is sort of the baseline. It's a very simple, sigmoid curve here. Obviously, it starts off from, if you can see the bottom row, it's scores of 1 to 10, 11 here, actually. And then this is the sort of the distribution. So every, 100% of all of everyone's transactions have a score greater than 1. 1 being the lowest. And then, slowly as you go down on the blue line, so around, 50% have a score above 6, near 7. And the gray line we have here is our validation set. And so completely unseen data, what would it look like? So this gap is sort of the minimum and the maximum, we could say. The minimum allowed value and the maximum allowed value. The orange values we had here, actually, these are the values that we discovered previously. And as you can see, all of this users, or many of his transactions were actually very, very anomalous. And there was a big gap. And you can see here in this one little section, there was actually, quite a few of them, actually, about 35% of them were extremely, extremely anomalous. So this obviously triggered us, and we decided to look into it further. And when I said before about transfer learning, we ran it through a second model that was very specifically tuned to look for check kiting. And here, in fact, we actually did one. We did find one. We passed it on to an SME, and it was confirmed. Another use case I'd like to discuss is stolen card data. And, stolen card or stolen number is more or less what we're looking for nowadays. It is becoming a major problem simply because it's so easy to go online shopping, and you don't actually physically have to produce a card anymore. As long as you have the number, the expiration date, and sort of the pin on the back, you can more or less use it anywhere you'd like. So what we do to catch these is we sort of look at regular use patterns. Very, very simply, if someone spends all the shopping in BC, if all of a sudden they start shopping in Ontario, that's obviously going to flag it because it's something they've never done before. So what we do is, again, we start with the generalized ground truth model here, and this time we sort of tweak it to sort of group them by user basis. So all of these sort of little clumps are individual users and all of their patterns put together. And this as a whole is a snapshot of the entire user base. And they're grouped by obviously, certain known patterns, but also lots of hidden patterns that maybe the human eye or the human brain can't really see. It's very good, again, for clustering. And so here we can actually divide, you can see two distinct groups vertically and then about 4 or 5 horizontally. So this is sort of, shuffling and binning users by itself. And we transfer this now to user patterns. And what we do is we take each individual cluster and we sort of give it a fingerprint, so to speak, or a voice print. And this uniquely identifies each user. Everyone will have a different sort of wave associated. And any subsequent transaction can be compared to that and, regraphed onto here. And if it does fall very far out of its user range or of its previous range, an alert can be triggered to sort of, require further action and whether we should check in on it. So one of the cases we actually had here, the value obviously came out. And so we used the model and we actually went back into the autoencoder. You actually can get a sort of a snapshot into what it's thinking. And, a very quick sort of aside here, a caveat about machine learning models is that they're very good at, pointing in directions, how it was done, where it was done, when it was done. What they are not very good at is instinctively explaining why things were done. This is obviously where the human knowledge really, really comes to the forefront. Mixing the two of them and augmenting them is what makes these models so powerful. And in this case, what actually happened was the green bars are sort of the prediction of what the model when the model was expecting this transaction to have occurred. And so obviously you can tell, judging by this user's pattern, most of his shopping was done between 8 a.m. to 8 p.m. with a peak of around 2 p.m. to 4 p.m. So that's sort of what it was expecting. There was a tiny little prediction here around midnight, probably since what was being bought. But the actual answer here was actually a midnight transaction. And because this was so at odds with what it was expecting, an alert was triggered. And it turns out that, someone actually in a different time zone had been shopping with this person's credit card, and we were able to find it very quickly. So I'd like to pass it back to Arturo to give us a little bit more use cases. Thank you.
Awesome. Thank you for that, Joseph. And now just to talk about some bank prevention strategies. So preventing card not present fraud, we can take a look at some analytics or rules, such as, provide a risk scoring at the transaction level. Basically, it's to capture out of trend spending patterns. Does your customer, you have a customer that uses the card for groceries and gas normally, and then all of a sudden there's a large purchase online. Have a solution in place that can provide you an alert to detect that change of pattern and have a higher scoring for that change of pattern. You can also use analytic to alert high velocity transactions. So in terms of volume, depending on the size of the bank, 1 or 2 transactions is normal from the same merchant, or if you want to detect 5 or 6 transactions from the same merchant the same day, you have an alert for that. You can also use analytics to focus on transactions that you can't charge back on. So it's more for recovery, right? So know the rules in the chargeback process. Um, you focus your efforts and your strategies on merchants that have a secure code 1 and 2 for MasterCard, for example, or merchants that have um, verified by Visa 5 and 6. So these are rules in the back end saying that these are transactions that you can't recover on. So preventing bust out fraud, implement a 5 business day clearing period, which is the banking standards. There are banks out there that push it till 30 days before they start clearing funds. But I think 5 business day is a good rule to have. You can also use analytics to identify check payments versus electronic payments. Again, it's behavioral type activity. Does your customer deposit checks often, or is this a one-time deposit, one-time large check deposit followed by aggressive transactions, or multiple cash withdrawals followed by the check payment, right? You can also have an alert that says, hey, this customer makes monthly electronic payments, and all of a sudden there's a large check payment. And lastly, you can call the depositor's bank if the customer says, hey, I need the money right away and it's urgent. You don't hesitate to call the depositor's bank and ask if funds are available. Once they confirm that the funds are available, then go ahead and clear the check for your customer. Preventing ATO fraud or account takeover. You can use analytics to alert account level changes. So any authorized users being added, address and phone number updates or changes, and followed by card requests. You can also use analytics to identify change of spending pattern. So once an ATO change happens in the account level, what happens next is change of spending pattern, right? You generally have a good idea of what your customer or how much your customer uses the card per month or daily, and then if there's an increase in volume, definitely have an alert for that. So preventing ID fraud. So ID verification, if ID given is valid. So basically what this means is, validate the ID being given during the onboarding or during the application stage. So an example I gave here is parts of Ontario driver's license should include the customer's date of birth. The first letter of the driver's license is the first letter of your customer's last name, for example. You know, you can tell if it's a fictitious ID being given because they sometimes don't follow the method of the ID, or how it's being implemented is just a bunch of random information being thrown on an ID card, right? So be on the lookout for that. Also, screening process to deter criminals from applying at your bank. So have a screening process in place. Last thing you need or you want is to have a business relationship with known criminals or known terrorists or entities, right? Yeah, review consumer alerts. Um, this is a strategy to prevent ID fraud because usually consumer alerts are added on customers' credit bureaus by the customer. So if a customer has the alert in their bureau, as a bank, your due diligence is to call the customer and just to check with them if they did apply for a card or if they applied for a product before approving the the product or the card. Again, review discrepancies with bureau information versus application information. So if a fraudster has stolen a card and tries to apply for a new product, they will probably just have the customer's name, and then they'll just make up an address, a date of birth, employers, etc. When you're reviewing applications, you will probably have access to the bureau information. So just make sure that the bureau and application information matches, or if they don't, make sure that you're taking proper measures of identifying your customers. Also, you can make an out call, simple out call to verify the employer.
sorry, make an outcall to the employer to verify the customer if necessary, right? If you've exhausted all your investigative techniques and you're still suspicious, don't hesitate to call the employer and just say, hey, does this customer work there? Preventing loss and stolen fraud. So you can definitely use analytics to detect spending pattern changes. So again, from low to high volume. So your customers is normally using the card, 5 transactions a day, and then all of a sudden it came to 20 transactions a day. So a good indicator that a card has been lost or stolen is a change of spending pattern. You can also have an alert to detect small monetary value transactions, again for testing. So if you lose a card once, if someone picks it up, first thing they usually do is go to a unattended merchant like a gas station, and or a PayPass merchant, and then they'll just tap the card basically just to see if the card gets approved or not. And once they know it gets approved, then they'll probably go use it for a larger amount, somewhere else. Preventing internal fraud. Ensure that you're reviewing your top performers to capture irregular practices or forgery. So regular practice, what I mean by that is, you know, there are employers or employees out there that will increase the credit limit or approve a credit card without obtaining the proper documents from the customer. And I think the purpose of that is, there's bonus programs out there that your employees obviously want to hit because they want to get a big bonus at the end of the year for whatever reasons that they have, right? But make sure that you're reviewing all products that are being increased, have the proper documentations and the customer approval for sure. You can also review the accounts work by your employees to ensure that there's business purposes. So what I mean by that is, review the accounts being worked by employees and the customers, and make sure that the customer did in fact required assistance. Or for example, why is your employee looking at a bunch of customer account numbers? And was there a business purpose, or are they just looking at a bunch of account numbers for no reason? You can definitely use analytics to provide alerts with emails containing card info or customer information. So have an alert or an analytic in place to provide alerts, incoming or outgoing emails that contain, name, address, date of birth, all the KYC essentials, along with, card information, capture card numbers or BIN numbers of your products, right? And lastly, review your applicant's resume during the onboarding process for inconsistencies, and also follow up to make sure that the sources that they provide you are reliable, right? So this rule basically focuses on, there are organized crimes out there that have criminals that apply for at banks, and their sole purpose is to, steal customer data or bank data, and then work for the bank for 2 weeks, 2 months, and then all of a sudden they quit and then they move to a different bank and do the same thing again. So make sure that you're following up on your applicant's resume. So key takeaways. We've learned that as one fraud type decreases, another fraud type will increase. So we saw that in the slide, in the fraud loss slide, where counterfeit fraud has been decreasing, but we've seen that CNP or card not present fraud has been increasing, right? So again, fraud evolves, and it's always an ongoing trend, but it changes from different fraud types. To assist with minimizing risks, make sure that you incorporate an effective fraud solution to leverage a risk assessment program that is customizable and involving a process using reliable data and an intuitive platform. So again, goes back to having a program, a customizable program to adapt to fraud trends. Industry expertise in tandem with artificial intelligence anomaly models can enable banks to identify, investigate, and prevent fraud trends efficiently. and effectively. Again, thank you for attending our webinar today. If you have any comments or additional inquiries, please do reach out at our email here or visit the website with the link here. Thank you.